Welcome to Accounting with Professor Lamptey. A company can report millions of dollars in revenue and still struggle to pay its bills. In some cases, a company can look successful on the income statement and still move toward financial trouble. Why? Because revenue is not the same as cash, profit is not the same as liquidity, and having assets does not always mean the business can pay what it owes today. That is why liquidity ratios matter. Today, we are going to explain two important ratios that help reveal whether a business can actually pay its short-term obligations: the current ratio and the quick ratio. By the end of this video, you will understand how these two ratios help answer one powerful question: can the business pay its bills when they come due? Let's begin. Liquidity means the ability of a business to pay its short-term obligations when they come due. In simple terms, liquidity asks, can the business pay suppliers? Can it pay employees? Can it pay taxes? Can it pay short-term loans? Can it handle obligations that are due soon? That is what liquidity is about. Now, liquidity is not the same as profitability. Profitability asks, did the business make money? Liquidity asks, does the business have enough short-term resources to pay short-term debts? Those are related questions, but they are not the same question. A business can be profitable and still have liquidity problems. For example, suppose a business made a large sale on account. The income statement may show revenue. The business may even report net income. But if the customer has not paid cash yet, the business may not have enough cash to pay its own bills. So on paper, the business may look profitable, but in reality, it may be struggling with cash. That is a liquidity issue. Another example is inventory. A business may have a lot of inventory sitting on the shelves. Inventory is an asset, but if that inventory is not selling quickly, it may not help the business pay salaries, rent, or suppliers today. So liquidity is not only about having assets, it is about having assets that can help the business meet short-term obligations. That is why liquidity ratios are important. Now, where do we get the information for liquidity ratios? We usually get it from the balance sheet. Remember, the balance sheet reports assets, liabilities, and owner's equity at a specific date. For liquidity ratios, we focus mainly on two parts of the balance sheet: current assets and current liabilities. Current assets are assets expected to be converted into cash, sold, or used up within 1 year or the operating cycle, whichever is longer. Examples include cash, accounts receivable, inventory, supplies, and prepaid expenses. Cash is already available. Accounts receivable represents money customers owe the business. Inventory is expected to be sold. Supplies are expected to be used. Prepaid expenses represent benefits the business has already paid for, but has not fully used yet. Current liabilities are obligations expected to be paid within 1 year or the operating cycle, whichever is longer. Examples include accounts payable, salaries payable, interest payable, taxes payable, unearned revenue, and the current portion of long-term debt. Accounts payable means the business owes suppliers. Salaries payable means the business owes employees. Taxes payable means the business owes taxes. Unearned revenue means the business has received cash, but still owes goods or services. The current portion of long-term debt is the part of a long-term loan that must be paid within the next year. So liquidity ratios compare short-term resources with short-term obligations. That is the key idea. We are asking whether the business has enough current resources to cover what it must pay soon. Now let's begin with the first liquidity ratio, the current ratio. The formula is current ratio equals current assets divided by current liabilities. This ratio asks, for every $1 of current liabilities, how many dollars of current assets does the business have? Let's use an example. Suppose Lamptey Consulting has current assets of $60,000 and current liabilities of $30,000. The current ratio would be $60,000 divided by $30,000. That equals 2.0. So the current ratio is 2.0. What does that mean? It means that for every $1 of current liabilities, the business has $2 of current assets. In general, that sounds positive. The business appears to have more current assets than current liabilities. A current ratio above 1.0 means current assets exceed current liabilities. A current ratio of 1.0 means current assets equal current liabilities. A current ratio below 1.0 means current liabilities exceed current assets. That may signal liquidity pressure. But here is where we need to be careful. A current ratio is not automatically good just because it is high. Students often think the higher the current ratio, the better, but not always. A very low current ratio may indicate that the business may struggle to pay short-term obligations, but a very high current ratio may also raise questions. Maybe the business is holding too much cash that could be invested in operations. Maybe accounts receivable is not being collected quickly. Maybe inventory is piling up because products are not selling. So the current ratio must be interpreted carefully. Now let's talk about one limitation of the current ratio. The current ratio includes all current assets. That includes cash. That includes accounts receivable. That includes inventory. That may include supplies. And that may include prepaid expenses. But not all current assets are equally liquid. Cash is very liquid because it is already cash. Accounts receivable is fairly liquid, but only if customers pay on time. Inventory is less liquid because the business must first sell it. Supplies are used in operations, but they are not normally used to pay liabilities. Prepaid expenses are current assets, but they usually cannot be used to pay debts. For example, prepaid insurance is an asset because the business has future insurance coverage, but you cannot normally use prepaid insurance to pay accounts payable. You cannot usually call your supplier and say, "I owe you money, but I have prepaid insurance, so let me pay you with that." That is not how it works. So the current ratio gives us a broad view of liquidity, but it may be too generous. It may make the business look more liquid than it really is. That brings us to the second ratio, the quick ratio. The quick ratio is also called the acid test ratio. It is a stricter liquidity ratio. Why? Because it focuses only on the assets closest to cash. The formula is quick ratio equals quick assets divided by current liabilities. Quick assets usually include cash, cash equivalents, short-term investments, and accounts receivable. In many beginner accounting classes, you can think of quick assets as cash plus accounts receivable. Sometimes short-term investments are included if they exist. But quick assets usually exclude inventory, supplies, and prepaid expenses. Why? Because those assets are not as quickly available to pay bills. Inventory must be sold first. Supplies are used in operations. Prepaid expenses have already been paid and usually cannot be converted back into cash easily. So the quick ratio is more conservative than the current ratio. It gives us a stricter view of whether the business can pay short-term obligations using the most liquid current assets. Now let's continue with the Lamptey Consulting example. Suppose Lamptey Consulting has cash of $20,000, accounts receivable of $15,000, inventory of $25,000, and current liabilities of $30,000. First, calculate the current ratio. Current assets include cash, accounts receivable, and inventory. So current assets are $20,000 plus $15,000 plus $25,000. That equals $60,000. Current liabilities are $30,000. So the current ratio is still 2.0. Now let's calculate the quick ratio. Quick assets include cash and accounts receivable. So quick assets are $20,000 plus $15,000. That equals $35,000. Now divide quick assets by current liabilities. $35,000 divided by $30,000 equals 1.17. So the quick ratio is 1.17. Now compare the two ratios. The current ratio is 2.0. The quick ratio is 1.17. Both ratios are useful, but they tell slightly different stories. The current ratio says the business has $2 of current assets for every $1 of current liabilities. That is the broad view. The quick ratio says if we focus only on the assets closest to cash, the business has about $1.17 of quick assets for every $1 of current liabilities. That is the stricter view. Now let's discuss interpretation. A current ratio around 1.5 to 2.0 or higher is often considered healthy in many situations. But that is not a universal rule. It varies by industry, it varies by company, it varies by business model. A quick ratio near or above 1.0 is generally reassuring because it suggests the business may be able to cover current liabilities with assets that are close to cash. But again, context matters. So always compare liquidity ratios to prior periods. Compare them to competitors. Compare them to industry averages. And compare them to the company's cash flows. Now let's talk about common mistakes. Mistake number 1. Assuming a high current ratio is always good. Mistake number 2. Forgetting that inventory may not sell quickly. Mistake number 3. Including prepaid expenses in the quick ratio. Mistake number 4. Confusing liquidity with profitability. Mistake number 5. Calculating the ratio without interpretation. Calculation is only the first step. The real skill is explaining what the ratio means. Do not just say, the current ratio is 2.0. Say what that means. Say whether it appears strong or weak. Say what may explain the ratio. Say what else you would want to examine. That is analysis. Now let's summarize. Liquidity measures the ability of a business to pay short-term obligations when they come due. The current ratio measures whether current assets can cover current liabilities. The quick ratio measures whether the most liquid current assets can cover current liabilities. Current ratio is broader. Quick ratio is stricter. Current ratio includes inventory and prepaid expenses. Quick ratio usually excludes inventory, supplies, and prepaid expenses. In our example, Lamptey Consulting had a current ratio of 2.0. That means it had $2 of current assets for every $1 of current liabilities. Lamptey Consulting had a quick ratio of 1.17. That means it had about $1.17 of quick assets for every $1 of current liabilities. So when you analyze liquidity, ask 3 questions. Does the business have enough current assets? How quickly can those assets become cash? And can the business pay its short-term obligations when they come due? That is liquidity analysis. If this lesson helped you, subscribe to Accounting with Professor Lamptey, hit the like button, and leave a comment with the accounting topic that confuses you the most. We are breaking down accounting concepts, simple, clear, and accurate.